Let's say good morning and hello to Deven Choksey. And Deven bhai, good morning. Thank you for joining us.
Good morning, Nikhil. Good morning.
Is the zing in your voice because of the stock movement in Adani?
Well, I think one is happy at the same time because I think the dust is getting cleared. And also at the same time, I think the fundamentals of the companies are now once again getting recognized. More importantly, I think when you see 60,000 crore worth of EBITDA, more importantly, when you see 3.5 times to EBITDA as your debt, and importantly, I think the capitalization which has happened in last 7, 8, 9 months, as far as I think various businesses are concerned within the group, these are all some of the fundamental moves which I would believe that I think could give us a good amount of confidence to stay invested into the company. Yes, I think the realizations comes very clearly as far as I think the market is concerned. But anything which is overpriced, I think market would not be kind in accepting it. And that's where probably I think one will have to remain careful about as far as I think the portfolio investment is concerned. But otherwise, I think the values are definitely there in most of these businesses. Having completed the capex program and having started generating the annuity revenue in variety of infrastructure assets that the group is holding, possibly I think one would find an argument for keeping the stocks in the portfolio, and particularly in every dip or every correction, that could mean I think a meaningful opportunity to add into the portfolio.
You track IRDA. It went public sub 40 rupees. It's a PSU stock. And from the IPO price to yesterday's closing price, it's already almost like a 2.5x.
Yes, Nikunj, I think, and though it is slightly surprising also at the same time, but I think one realization comes out very clearly that there is a requirement for new stocks into the portfolio, largely because of the fact that I think most of the funds today have enough amount of exposure in existing listed stocks. As a result of which, I think they don't have the ability to add new stocks, I think the new quantity or new weight into the existing portfolio of stocks. So whenever the newer businesses are getting listed, the automatically exposure is getting created into these companies. Fortunately, today the amount of inflow of money is so high that I think some of these new listed companies are finding a meaningful acceptance into the marketplace, into the portfolio. And IREDA is basically, I think, one such company which is showing that kind of a promise. Of course, and the underlying story remains extremely strong from the fundamental perspective about the renewable energy space in which the company is being funding, and I think the entire NBFC package, entire NBFC space, I think for this particular sector is remaining, I think, exciting given the kind of visibility that one has seen. So yes, I think mostly the inflow of money is driving the stock prices of some of these newly listed companies. Of course, I think they're fundamentally strong business models.
Deven, hi, morning. Let's get in your take then on the rejig at Infosys. Clearly, we've seen the ADR bearing the brunt of that. Your view on how shareholders should read into this?
Good morning, Evan. Well, I guess I think the important aspect about the every top management or the key management position, basically when it takes change, I think market is always looking at the new person with a good amount of I think expectation. Here too, I think one would like to clearly listen to how exactly I think the new CFO is assuming the charge and what exactly is the game plan going forward. Whether it would be the focus on maintaining the cost and improving the margin, or whether I think enabling the organization with higher amount of trust on winning the newer contracts from the new customers by creating the competitive environment. These are some of the points I think which definitely remains as a stronger point from the new positions, be it CEO, be it CFO. So that is where probably I think the market would be looking at the views of the person I think which is entering into this particular space. I think that for a company like Infosys, TCS, such kind of exit, I think doesn't make much difference, honestly, because I think these institutions have created sufficient amount of, I think, bandwidth in the organization to take up the leadership position. Hopefully, I think the new leaders continue for a longer period of time. That could be the hope that investors would give.
Okay, let's move right on then and focus in yet again on FMCG. ITC is all set to host their annual investor analyst meet. So, what exactly will be some of the key focal points? And CLSA has come out with their latest note on the same. Let's get in Vinny here with all the details. Vinny?
Good morning, and absolutely what we're talking about in terms of expectations from today's ITC analyst meet that is being held is that one, and any update that would be coming in on the ITC's next strategy, especially in the research and development front, as well as in the supply chain and digital front, is something that we're keeping an eye out on. Other than that, medium to margin aspirations of the company in the other FMCG business is a key factor to watch out for, as well as in the cigarette business, what's the growth outlook of the company, as well as assuming the consumption has normalized. That's the key factor to watch out for as well. Any updates that we could be getting from the company in terms of the hotel business, the listing, where is the progress going so far as well, are the key factors to watch out for from ITC's analyst meets today. So let's keep an eye out on that.
Nuresh, IT's my bad. Actually, Rudra is there. Sorry, Rudra. It's just that so accustomed to having Nuresh. We should call you more often, so that, at least my muscle memory goes to Rudra. ITC has fallen off the cliff, so to speak. I mean, in terms of absolute gains, yes, but in terms of last 3 months' performance, it's just been sideways now.
Nikunj, for me, ITC is one of the outliers or a stock which can outperform in FMCG. If I look at other stocks like Hindustan Unilever, or even if I see Dabur, Tata Consumer, some of these stocks are definitely not showing me strength. So for me, among the lot of stocks which are available in FMCG, yes, ITC is the number one pick. And this stock has consolidated now for a long time. Yes, there is a strong base at around 430-35 zone. And again, this stock is finding resistance at around 460 zone. So once it makes this move above levels of around 460, 465, it can go back to those levels of around 485 to 490 zone. So for me, ITC will outperform. However, I am not so positive on sector as such for FMCG, but one can definitely look at buying ITC at current levels or on any dips to those strong support areas of around 435 zone, looking at initial targets of around 475 and then that 490 to come.
You heard out some of that commentary as well coming in from the FMCG players. Give us your sense as to how you've looked at the rural slowdown, festive sales not quite picking up, and what this really spells out for the entire consumption space, large and mid-cap, and where does your preference lie? Deven, yes, that was for you.
Okay. So, well, I think the one important aspect that in the rural consumption, the amount of money available in the hands of the consumers is probably increasing very smartly. We are having larger part of the infrastructure projects getting executed into the rural economy, and as a result of which, I think the employment generation onwards to the newer industries which are coming up, everything is basically suggesting that the rural masses are getting maximum benefited out of the spending which is happening into the hinterland of the country. I would think that the consumption space, particularly I think the FMCG space, be it in the food category, be it in the personal care category, be it in the home care category, in each of these category, you would probably find the growth in the volume increasing going forward because of the larger amount of participation of masses into the rural economy. Would remain extremely positive. However, I think would remain mindful at the same time. Maybe double the size of the GDP would be the growth that one could expect out of the consumption companies like FMCG companies. And that could be the area where probably I think one will have to look at valuations carefully. Most of the consumer companies, the FMCG companies particularly, right now priced adequately. And I think there is little less headroom available. So unless market gives some meaningful sharp correction in a given period, probably I think one would not buy immediately. Or let it be time correction, and then one would buy with a future outlook on FY 25-26 earnings. That would be probably, I think, more meaningful going forward.
Okay. I'm going to go and talk about private banks and small private banks. And frankly, there is no pattern here. Now, let's assume that last Monday or from December, let's start the month to date change for private banks. HDFC Bank, Axis Bank, IndusInd Bank. Then throw in the smaller banks here. That's HDFC Bank for you, it is up 6% this year, but flat with a negative bias for the year. That's IndusInd Bank for you, this month up 4%, but flat to a positive bias this year. It's really hit out of the park. Third, let's look at Axis Bank. Up 7% this month, that's ICICI Bank for you, but the bias I think is positive. But in smaller private banks, I guess the move is very distorted. Let's look at some examples here. IDFC Bank. It may have not done great in this month, 1.4%. But for the year, IDFC Bank has been one of those real outliers. It is an outlier, 48% this year. Flip it around with Federal Bank. Federal Bank in last 1 month, and when I say last month, I'm looking at, let's say, the state election voting as a turning point for banks. In this year, it is up 10%, and this month it has done 3%. So within banks also, who says that there are no winners? There are winners, but there are winners in the mid-cap banking space. Kunal, is that a fair summary?
Yeah, I think it's a very good summary, Nikunj, that within the banking stock, within the Bank Nifty or the banking universe, there are a lot of stocks moving into a desynchronized manner. So, and I think that was the bigger reason why the markets were moving up higher, rather the benchmark index was moving up higher, but there was no confidence emerging into the banking index. So, at a point where I remember, I think from the July tops or July 2023 highs, when the Nifty corrected, I think 4 or 5% odd from 20,000 to 18,800 approximately. Bank Nifty corrected more than 9% to 10% from those highs, and that was one of the major reasons why. So a sector underperforms when the stocks get into a desynchronized price actions, and it's just off late, as you can see that as you rightly pointed out from December. Points that many of the large cap private sector banks are making a comeback. Even the beleaguered banks like, for example, RBL Bank, etc., they are also making a comeback for themselves. So it seems like that this seems to be now a synchronized move for the banking index, but it should not be a short-lived move. We would probably need to see this move lasting for at least 2 to 3 months, if not more.
Okay, here's a list of some QIPs. While we'll get list of IPOs going, QIPs, Apar 1000 crore, Jupiter Wagon 400 crores, Bank of India 4500 crores, Titagar 700 crore, JNK Bank 750 crore. Deven bhai, I'll take the banks out. And I mean, what a irony. 2018, the banks had to be recapitalized at sub-book by Government of India. Nobody wanted to buy them. I mean, if there was a barge pole, everybody bought that barge pole and said, we'll avoid private PSU banks with a barge pole. Look at where they stand today. They are doing QIPs. And if Bank of India QIP is anything to go by, the institutional interest, the retail interest, the HNI interest, everybody now wants to lap up PSU banks. What has changed? And do you think it's still a good time, let's say, to buy into top 2 or 3 PSU banks?
It's a very pertinent point, Nikunj, and I believe that some of the larger banks would make a case to buy into the portfolio. And the reason would be, I think, as clear as probably I'm thinking at this point of time. On one side, the balance sheets are cleaned. On the other side, I think there is no reckless lending, which earlier used to happen. So that gives you the assurance. Then on the top of it, I think the portfolio is getting distributed between the MSME and the corporate sector on one side and retail on the other side. So that is distinctly, I think, the way of working at, say, for example, SBI, say, for example, with Bank of Baroda. So you definitely find, I think, that these banks are tuning themselves more in line with the corporate banks, the private sector, as far as I think their operations are concerned. They are not lagging behind in adapting to the technology. They are equally, I think, putting, say, brave effort, I think, in building the front end, which is fintech front end. So all in all put together, I think the confidence says that I think this bank should get re-rated. However, with a caveat, I feel that some of the small and the mid-sized PSU banks definitely will improve because I think there will be a case for inclusion in the portfolio because of the weightage allocation policy. More importantly, the size of the balance sheet would matter as far as I think the long-term investors are concerned. If you are getting the advantage of a larger size of the balance sheet, and if economy is transforming from less than $4 trillion to $12 trillion in next 10, 11 years time, larger the size of the bank, larger the AUM ability to lend, I would think that I think they would be in a much better position. And that is where probably I think within this PSU or PSB space, I would think that the likes of SBI, likes of BOB would remain more a stronger case to add into the portfolio because they are showing the signs of doubling the balance sheet in 4.5 to 5 years time, which is fundamentally very more important to me as the economy grows. I think the banks are participating into that.
Okay, stay with us, and we've also got a very special interaction on the latest show, Khane Pe Charcha, with none other than Hansa Yogendra. Take a look at a sneak peek.
It gives me an honor to invite Hansa Ma on this episode of Khane Pe Charcha. Namaskar.
Namaskar, namaskar. It's lovely to be with you.
They always say, Hansa Ma, mind is the thought you have and your body is the food you eat.
Right?
So yoga के
As the food, so the mind.
Exactly.
As the mind, so the man.
Hansa Ma, हम stock markets में हमेशा बोलते हैं कि bull market is relaxing, so सांस लो. Bear market is always tension, सांस छोड़ो. Bull market, buy a good stock,
Hold it.
and when it reaches fair value,
Leave it.
sell it.
Correct.
Bull and bear
great.
yoga.
Deven, I wonder if you're doing any yoga poses to make your breathing more stable, etc., at a time when the markets are moving from strength to strength.
Yes, sir, and I think this is a regular everyday morning ritual, getting up from the bed and I think do the yoga and Patanjali yoga as we continue to do. We follow Hansaji and probably I think we carry out our exercise in the same manner in which he is teaching us. So frankly, very happy that I think this gives us a good amount of balance of mind in the hectic day when we are entering into the office.
Even by market, my fashionable word is marathon. Everybody's running marathon, all the HNI investors. You should be running marathon.
Yes, I think as I'm happy with my brisk walking, I complete my walk in 45 minutes for 5 kilometers. So I guess I think that is where probably I think I'm devoting more time every day.
He goes for a walk also. I've seen him early morning. So Kunal, have you managed to change anything there?
Yeah, there are quite a few changes, Nikunj.
Like?
You're more active. I think you can sleep well. No stress from trading also.
Rudra?
Yes, Nikunj, definitely. Market marathon has been very good, both in Nifty, Bank Nifty, and a lot of few stocks in last
नहीं
1
होती है
month.
Rudra. Everything is not market. There is life beyond 3:30.
Morning, I definitely have my morning walk and yoga, balance of both mind as well as body.
I'm glad to hear that. I'm so glad to hear that. You know, I just get a sense that suddenly India is getting very, very health conscious. Look at the trends, look at what we have in terms of availability, look at what people are consuming. So, I mean, it's so good to hear that. Okay, back to markets, and I'm going to pick up a list of stocks which, in a sense, did see a lot of price action yesterday on the upside. And we want to call them as breakout stocks. And Kunal, good old railway stocks, REITs and RVNL. And even IRFC, all railway stocks are back.
Yeah, I think yesterday there was a good price volume day for many of the railway stocks. I was looking at the charts for IRFC, IRCON, RVNL, and it seems like these stocks are now coming back towards ending their 2-3 months of consolidation. So I think September is where these stocks had made an interim kind of a high. Post that, there was a 10% to 20% broad correction for these names, where many of the names like IRFC, IRCON, RVNL, RITES, etc., these stocks had gone through a corrective phase. But I think these stocks are now trying to make a comeback for themselves. So this could be a good pocket to trade back again because of the fact that these stocks are looking like they've ended their time-wise consolidation.
All right, let's shift focus then to SBI because Nomura has come out with their latest report. It's a buy rating with a 665 rupee target price. In fact, the brokerage house believes that the wage revisions could be negative for the bank. Let's get in Vamakshi. She joins in with all the key takeaways. What does Nomura have to say, Vamakshi?
Well, yes, SBI is in focus today after Indian Banks Association has agreed to a wage revision of almost 17% that will be effective from November 2022. Now, the banks will have to make retrospective adjustments to their wage bills, and the wage revision settlement will actually be effective for a period of almost 5 years. Now keep in mind that in quarter 2, SBI had made provisions for wage settlement, factoring in a nearly 14% wage growth as compared to the 17% that has been now declared. In fact, in the second quarter itself, SBI had revised wage revision upwards from 10% to 14%, resulting in a one-time impact of almost 3,400 odd crores. Now, given the announcement that has come in, they will have to further revise it to 17% from 14% is what they had accounted for in quarter 2. And in fact, the management had said that for every 1% increase in the wage revision assumptions, the monthly wage bill actually increases by almost 100 odd crores. So overall, Nomura expects that this announcement could increase the wage bill for the second half of this year for SBI to the extent of almost 2,500 to almost 5,000 odd crores for SBI, and this in turn could lead to a negative impact on the company's POP to the extent of almost 3 to 5%, and even the net profit for FY24 could see an impact of almost 3 to 7% as per Nomura. But nevertheless, they've maintained their buy rating on SBI, target price of 665. But on the back of this announcement, keep an eye out on this counter.
Okay, that we will. That's the Nomura take on SBI coming in. But Deven, since Kunal was just flagging off that railway stocks are back once again after 3 months of consolidation, there was a lot of conjecture in the market whether the peak of the rally is behind us or not. Would you recommend buying fresh or adding positions to railway names here?
Yeah, Aisha, I think the important part is that this year the allocation in the capital expenditure program for railway is 250,000 crore. And as we understand, railway modernization is happening at a rapid speed with new Vande Bharat trains and also electrification of the tracks. I would think that the amount of money allocated towards the railway expansion and the capital expenditure would be significantly higher. So many of the capital goods companies, be it ABB, Siemens, even unlisted ones, Alstom, or for that matter, a host of the ancillary suppliers who are basically supplying to some of the larger OEMs as well as to railways, they would probably have relatively much better time. And that visibility is not only for 1 or 2 years. I believe this is a structural move, which is going to last for 8 to 10 years. So that is where probably one remain more confident about keeping the railway stocks in the portfolio. Of course, one will have to be selective in adding them at a valuation, price valuation, is important. So, but we remain overall, structural story remains absolutely promising for railways, and definitely we would say many companies are entering into the market coming period. And that is where the opportunity is much more seen because they will be entering into the IPO markets going forward. And that is where probably you can personally argue for adding such kind of stocks in the portfolio.
Okay, that's the take coming in. Look at IRCON this year itself. It's seen a 173% surge. IRFC, it's been a late mover. In that sense, 152% has been the move on IRFC. RITES as well, a 46% move, and I think the entire pack would have done that. Well, Titagarh, of course, has been the creamiest of the lot with a 376% move. Couple of other names, and there have been a whole host of QIPs as well. Today, you've got J&K Bank, and that's an ET Now Newsbreak which got confirmed. The J&K Bank is going to be launching a QIP. They're looking to raise about 750 odd crore rupees. There's also Sterling and Wilson, wherein a QIP is going to be initiated for raising about 1,500 crore rupees. So look out for some of these interesting names at that. But, Deven, we've discussed banks, but some of these smaller, more niche regional players, a Jammu and Kashmir Bank, for instance. And again, this year so far, it's made some decent returns for itself. If you can just bring up the YTD chart there. Late mover, started off only in the last 5 odd months or so, but a 121% return. Or for that matter, Bank of India, wherein the QIP saw so much interest.
Aisha, when economy in general starts moving up and when the entire MSME fabric, is now getting expanded, stretched, I would think that it is going to be the important role for most of the banks, and particularly because they have corrected their balance sheet, they have the ability to lend, and they are capitalizing themselves by raising more money at this juncture. So all in all put together, certainly, they are having a case as far as the growth is concerned. Valuation is also on their side. The support is coming because the investor wants to buy something which is having least amount of risk. And many of the PSB, the smaller ones, have got relatively high comfort on the valuation side with a cleaner balance sheet. So definitely one can argue that the re-rating is in making for some of these banks. However, my main point is that if you have to drive long, then possibly I think you will have to look at these banks from the point of view of creating a size. Some of these banks might probably consolidate in subsequent period of time, like earlier case I think of PSBs, which consolidated. Some of these smaller banks, if they do consolidate, then according to me, I think the size would give them the advantage going forward, and that is what one can argue for. So we are selectively confident about buying into the portfolio, even the mid-size and small-size PSBs, but larger amount of comfortable stays with the large cap banks where they've got the size of the AUM to offer as far as the growth participation is concerned in the economy.
Deven, great to have you on the show. We'll let you go on that note. Good chatting with you as always.